I think GP stakes is the most under the radar asset class of 2025. Frankly, it's been under the radar for the last 10 plus years. And it's also the most underappreciated asset class that I think most high net worth investors don't have exposure to yet, but should really take a hard look at in 2025 and of course beyond. So in this video, we're going to go over some of the industry trends that are affecting private equity and specifically general partnership interest, GP stakes. All right, so let's get started. GP stakes investing, our outlook for 2025, and just what do distributions look like? What is the state of private equity? And we'll start with just a real quick overview on what actually GP stakes is for the participants that haven't gone through that yet. So starting off with, what is GP stakes? It is an investment into the general partnership of a private equity firm. So instead of investing in one private equity fund where you get exposure to maybe 10 companies, or if it's a real estate private equity fund, maybe it's 10, 20 real estate properties, you're actually investing in the ownership group, the general partnership private equity firm. And so you get to participate shoulder to shoulder with them as if you were a senior partner of that firm. Now you're a minority partner, basically a silent partner. So you don't have a vote in terms of how they run their companies, but you get controls over what they can and cannot do with your capital, the money that you've invested in the firm. And those profits that end up coming back to you tend to come back in three different buckets, right? The share of the management fees, that's the most important one. That really sets a floor on the downside in this asset class because the management fees are contractual with large limited partners underwriting, supporting those management fees, paying them to the private equity company each and every year across not only just one fund, but generally most of these private equity funds have 3, 4, 5, some have 10 funds that are in the marketplace today generating management fees. And then promoted profits, that's the carry, that's the profit share that the general partnership gets to take for each fund. Normally it's 20% for giant, large private equity groups that have billion-dollar plus funds. And then 3, the balance sheet investments, that is actually the general partner's own investment in each of their funds. Usually that's 2% to 5% of a co-investment in a large private equity fund. They have to actually write that check in order to go out and raise capital and show skin in the game to their limited partners. And so the returns from that investment, we also get to participate in. And so that's the cash flow stream that comes to us. And of course, there's also the appreciation, which is not covered here, but we'll get into that shortly. And here is the example list of private equity firms that have sold minority ownership positions. And so it's not just random no-name firms that are quite small and under the radar. These are large, well-known, big brand name firms with amazing track records, elite top-tier private equity firms that is surprising to most people that they would actually go and sell a minority position. But we can talk about that perhaps once we get through the market update. So once again, these are top tier elite firms. Most of them are raising $1 billion plus funds. They've gotten past the point where they are a startup private equity group that is hoping that they'll be able to raise a new one. These firms could actually underperform the next couple of funds and would still have the track record and LP relationships and the benefit of the doubt to still raise larger and larger funds, at least for an extended period of time. And that's really all we care about. As long as they can raise another fund after we make a minority investment in their firm, generally that means we are going to get not only all of our capital back, we're going to make some profits, which is a nice downside floor because we don't have to assume that for the next 10 years, they're going to continue to just hit it out of the park as they have in the past. We really just need them to maintain status quo, collect the management fees from the current funds, and then have one new fund that they go ahead and launch that we can get new management fees, new carry from on that incremental fundraise. Just to understand the economics of a GP stakes investment, management fees, here we're doing the math on a typical $1 billion fund. If they're getting 2% asset management fees on that $1 billion every year, they're getting $20 million, a 5-year fund. A lot of these funds can be 10 years long, but just for a 5-year example, they're getting $100 million in just management fees, which is like a bond feature of a private equity fund. Then they're getting their promoted interest, their carried interest on, say, an average 15% return private equity fund. You're going to get a double, a 2x, right, on that fund, which means there's going to be additional $200 million of profit on that billion, 20%. That's going to go to the general partnership. Then you get to add the balance sheet, the co-investment profits that we talked about. So they made a 2% investment into the billion-dollar fund as their co-investment. They doubled it with a 15% return over 5 years. That's an extra 20 million. And so in aggregate on just one fund, $1 billion fund, the private equity firm has made 320 million. And then if we had made an investment into the firm, we might be a 20% minority investment in this private equity firm. We would take our 20% share of any of those profits that were distributed. And maybe they would distribute half of it and then they'd reinvest into the subsequent fund. So you could see on a $20 million investment, on co-investment here for this private equity fund, they recouped 320 million. That's pretty good. That's a 16 multiple. And so this is the most leveraged way that you can participate in the private equity world, right? If you just invested in this fund as a limited partner, you would have got a great profit. You would have gotten your 2x or your 15% return and been pretty happy, especially relative to most stock market investments, because you would have a lot lower volatility too, right? It wouldn't have been up and down every year. You would just collect your 15% at the end of 5 years in aggregate, and you've been pretty happy. But if you were the GP, you're thrilled. And this is why 25% of the Forbes 400 richest people in the world are related to finance, and half of those are in private equity, because it's such a leveraged, compelling business model. If you can generate these types of returns, you get to participate in a disproportionate amount of wealth. But yet everybody's still happy because everybody in this scenario made a good return. And then we go on to the next fund, hopefully, if this was one of our investments. All right. Now that we've given you an overview of what GP States is, a reminder for perhaps some of you, let's talk about the current state. Obviously, 2022 and 23 were tougher environments for private equity. The distributions here are shown in the bars, and then the line graph is the actual percentage of the distributions relative to the net asset value of the fund. So it just gives you an indication of the overall liquidity in the market. So any given year, on average, 22% of the total value of these funds is getting paid out in distributions, profits, or cash flow distributions to the limited partners. Now, 2022 and 2023, the market for private equity M&A sales just fell off the face of the earth, right? Transactions were way down those 2 years. And so distributions are down relative to the NAV values. But the good news here is that, as you can see in 2024, distributions and then the percentage relative to NAV are starting to tick up. So it feels like we've gotten through the trough, and I'm sure everybody feels the market mood right now is certainly a lot stronger than it was a couple of years ago. And energy for transactions and brokers and investment bankers are certainly more excited about their prospects for M&A for large transactions in 2025 than they have been the last couple of years. That might be the new administration. That might just be, hey, it's time. We've had the Fed finally start to cut interest rates, and transactions are starting to make a little more sense. Also, sellers of companies are starting to capitulate because they realize we're probably not going back into a zero interest rate world. And so they still have life events happening, divorces, deaths, retirement, that they want to go ahead and sell their companies. And that leads to more transactions, certainly. So in other words, it feels like we've gotten through the trough and better times for transactions, and therefore liquidity looks compelling in 2025 and beyond. Now, regardless of that last couple year downturn, if you just look broadly over the last 35 years, private equity has actually performed, this is more than 35 years, but private equity has performed outstanding with a 14% IRR on average relative to the S&P 500 of 9.5% dating back to 1986. And that outperformance has happened in all kinds of interest rate environments, right? It wasn't like 86 to today was completely a straight down in interest rates. Yes, over time, interest rates have certainly fallen from the 70s, but in any given 5-year window, the interest rates are moving all over the place. And so private equity is, I think at this point, is proven to be a superior way to invest, to generate alpha versus investing in the S&P. And here's those returns shown over 10-year rolling periods. And so you can see it's a little smoother than the blue line and the red line here and the tan, which are public markets, both global and US. So you can see over 10-year rolling returns, private equity has always had a positive return in aggregate, right, over those 10 years. In 2008, obviously, the public markets dipped over 10-year returns. And has generated a wide spread of alpha, usually 400 plus basis points relative to the public markets. And now if we think about where are public market valuations today, obviously they're a little extended. This is the Mag 7 versus the X-Mag 7, the 493 other S&P 500 stocks. And they've been on a tear. Amazing companies, incredible profit generating machines, but certainly not cheap. And then if you think about that in the context of, okay, where are we from an overall standpoint of how the market has performed over time relative to where it is today. And so if you compare the distribution here of buyout is PE firms, that's the larger bulge here in dark blue. And then the S&P 500 is the light blue bulge. You can see that the S&P is on the 79th percentile of its trailing 5-year returns. It just means that it is performing above average relative to history. Now, private equity is also performing above average, but it's at the 62nd percentile at close to 15% over that trailing 5-year period. And if you just look at 1 year, the S&P is more like 85% above average relative to their historical performance. And this is just a visual way to show that the S&P is outperforming its historical averages more dramatically than private equity. So we have to think about relative valuation when we make incremental investments. If we have $1 million we want to invest, we got to think about where should we put that relative to our current allocation in our portfolio, what looks cheap, what looks expensive. And this helps inform us where those marginal investment dollars go. Okay, so I love this chart. So give me a minute to explain it because I know there's a lot of lines, a lot of colors, but this is fascinating to me because if you look on the left chart, you have various different strategies in private markets by 1 year returns. So if you invested in one fund in buyout, which is PE, venture capital, growth equity, it's a different version of PE, credit, that's debt, and infrastructure, here is your distribution of these returns. And you could see there's a lot more variability in the total returns that you could get, which makes sense if you're investing in one fund. Some funds are going to outperform and some funds are actually going to lose money over that 7-year period, right? If you just look at the aggregate world of all these funds. But now if you look at the right side here, this is if you take 10 of these funds in each of these asset classes and compare the performance of a diversified portfolio of these private equity funds. And so things get a lot tighter. The dispersion of returns really tightens up. And so you can see on the left-hand side of this chart here, you have credit, so debt and infrastructure, and which makes intuitive sense. They're not going to blow it out. They're never going to hit 20% returns, but their return dispersion is much tighter and it aggregates around that 9% overall return if you take 10 funds. So it's like a fund of funds comparison. And then you have growth equity. So that's private equity and buyout. It's just how big are the firms and what stage. The blend of those two is looking at private equity in aggregate. It's around that 15, 16% IRR in these funds. And then you have, of course, venture, which is why a fund of funds and venture actually are fairly compelling if you can get into the Sequoias of the world, right? Because those returns over 10 of those funds have always done very well. But it's very hard to get into those firms and you got to write giant checks. So I just like thinking about this in terms of GP stakes. When we invest in GP stakes, we're getting exposure to hundreds of underlying funds. So our return stream looks a lot closer to the right-hand side, at least it should. It should look a lot closer to the right-hand side of this chart versus the left. You invested in one individual fund. It's a crapshoot in terms of what return outcome you're going to get. This is why I don't advise investors take their private allocation and go invest in one private fund, right? I suggest they invest in multiple private assets in order to get diversification, just like they would if they invested in the S&P 500. They obviously are getting exposure to 5 different companies. We want that in the private markets as well. We might not need 500 different funds, but investing in a GP stakes portfolio of 50 plus managers means you're getting access to hundreds of underlying private equity funds, hence the return profile here on the right. This is pretty interesting, and I actually didn't fully appreciate this, and I study this stuff daily, is that if you look back the historical loss ratios by strategy, so in other words, if you look at all the funds in this particular asset class, what percentage of funds actually don't return the full principal back? This is a period of 2000 to 2020, and it's surprisingly high for real estate and natural resources, that's like timber. But real estate was surprising here. And part of that is because you got COVID and you have the great financial crisis, two, obviously horrible times for real estate.
in that time period, but still 25% of real estate funds didn't actually return 100% of the principal invested. Now, these are large private equity funds, real estate private equity funds. The smaller guys that are investing in a couple apartments, you have more outcomes where you can completely lose everything. I'm not saying that 25% of all real estate funds in the institutional market were complete losses. Very few are complete wipeouts. The majority of these losses in this 25% range for real estate were more like you lost 10% or you lost 5% on your total investment. But this still is an interesting comparison to buyout here in growth equity, or the left-hand side, or private equity, which had much lower loss ratios by comparison. And this is not a knock against real estate. I love real estate. We'll always own and continue to invest in real estate. But it's just interesting to me. This makes the argument that you should have more than just real estate exposure in your alternatives bucket in your portfolio. And so why would you want to have private markets in your portfolio? And not just public. As of 2024, it still is the most target-rich environment for alpha because it has the most companies. And most companies are private, and even very large companies above 100 million in annual revenues, 87% are in the private market. You're not getting daily valuations on each of those companies. Therefore, you're able to generate some alpha by buying things off market, doing things in a less competitive environment. Public markets are certainly more efficient in that regard. There's fewer of them. There's more attention on them. There's audited financials every quarter. Whereas the private market, you get quirky things. You could have a seller that is just doing things inefficiently because they don't have a lot of tension on them. And maybe they've owned a company for 40 years with zero debt and just haven't had the need to push operations. Maybe they're bloated on their operating expenses, or maybe they're not entering new markets because, hey, I'm 65, I'm plenty wealthy. Why would I need to go international with this firm? That sounds like a hassle. So this is just giving you an update on where we are in the comparison of public versus private companies. And I think this trend, I don't see it reversing anytime soon. It does seem like there are fewer companies that want to take on the administrative burden of going public. And you can see that in the number of public companies has trended down over time pretty steadily because you have to spend millions of dollars a year just in the SEC reporting. And I think that you're seeing this also with large tech firms. They found other ways to generate liquidity and capital raising than going public. This is a chart that gives you an indication of where we are in the life cycle, the growth of private assets, which has certainly been on an upward trend, but are still a tiny fraction of the overall global wealth. And this is just an update for 2024 here on where we are in terms of the size, the quantum of capital in these strategies versus, once again, global wealth. And so that's what we really care about in GP Stakes, is we care about this runway. How much growth do we have? How much can the private equity firms continue to fundraise and generate more and more asset management fees that end up going to us in terms of distributions? And of course, the larger they get in AUM, the more valuable those firms are when they go to sell them. If they do decide to go public at some point, if they have a secondary market transaction, they take on some debt, we get the benefit of those distributions and that increased valuation of those private equity firms. So in other words, just a long runway ahead. By no means are we in the fourth or fifth inning here. This is still the second inning, I think, in terms of the amount of money, the tailwind going to private equity versus just global wealth, which is mostly bonds, stocks, real estate. And the nice thing too here is that individuals are still a tiny fraction of this. Individuals have 3% of their portfolios in alternatives. And it's very clear that shift is changing as well. Private equity firms are starting to target that retail channel, that wealth channel, RIAs, investment advisors, in order to have their clients invest in private assets, because it does a lot of things for their clients, not only in terms of the higher returns that we've talked about, but also in reducing volatility of your overall portfolio. Because obviously you're not getting daily marks on your private real estate, your private company investments via private equity, maybe your debt investments if you're in a private credit fund. And so that volatility encourages better behavior for their investors, for their clients, which actually increases the value of these investment advisors' businesses, because if they don't have as many clients redeeming and pulling out because the stock market's down 25% one year and therefore their fees are down 25%. They're getting that generally 1% on their total assets under management in the investment advisor world. Whereas if they have a nice, healthy share of private assets and private equity, the volatility is dampened. If you can remember 2020, that was pretty scary for a lot of people to lose 25% of their net worth on paper if they were 100% stocks in a matter of weeks. And this is expanding that to just globally, where they think the global total allocation of alternative assets is going to be in the next, call it 7 to 8 years, is going to be close to $60 trillion from today. It's going to be 60 trillion versus 20 to call it 25. It depends on who you believe today in their estimate of valuations. So in other words, incredible growth, which is the entire opportunity in GP stakes, is taking a disproportionate share of the total global wealth and therefore increasing asset management fees, increasing ability to get those promoted profits, and just generally benefiting from this giant tailwind. So as an overview, why we love GP stakes in 2025 and beyond. Really, this is not a, hey, this is a tactical trade you should do this year, because this is an opportunity, we think, and that will go away over the short term if you do not act. I think this is something that you want to allocate to over time. And why not? Because you're getting distributions from the management fees, which are contractual in nature, have a nice bond-like quality to them. And then you also get that option upside from the appreciation of the private equity companies as they raise more and more assets under management. And so we think this makes sense to just own for the very long term. If you get an opportunity to own some of these world-class private equity firms, if you get an opportunity to be a senior partner in terms of economics of these firms, why would you ever want to give that away? We want to increase our ownership of these firms over time. And so we intend to keep making investments in the space for the long term. I view a general partnership as one of the best business models in the world that I and my family want exposure to for as long as it exists. As long as there's an opportunity to invest in general partnerships, we want to be allocating capital to it, because we can't think of any other industry. Enterprise software is close, but I can't think of any other industry that it is unlikely to be completely disrupted by AI, that can still generate really high profits, that has that built-in leverage that we talked about without taking on tremendous debt. You're leveraging your limited partner's capital to go out there and make great investments and participate in that upside without having the downside of signing for a giant loan, or as some real estate investors will do. You get exposure to a lot of the upside without that major downside that we've covered here. And so I think it's unique investment. It's still pretty under the radar. If you talk to people globally, very few people actually have invested in GP stakes, and that'll change over time. In 15 years, it might be different, but we think 2025 is a great entry point if you're going to start. All right. Thanks, everybody. Take care.